everyone, and welcome to Keep Calm and Money On, your personal financial coaching channel, where our goal is to give you peace of mind and security when it comes to your finances. I'm your host, Alina, and with the things we cover today, you'll be able to buy your life back so that you can own your future. As promised, today we're going to dissect retirement accounts. But because there's so much information I want to cover, I've actually split the topic up into two parts. The first episode will focus exclusively on 401ks, so traditional 401ks and Roth 401ks. And the second video will discuss traditional IRAs and Roth IRAs. If you already contribute to your retirement, or if you're looking to do so but don't know where to start, we'll cover the difference between the types of retirement accounts that are available, the maximum that can be contributed into each one, and their tax consequences. But before we dive in, make sure to click the subscribe button below the video and ring that little bell to let YouTube know that you don't want to miss any new episodes. I'm really trying to aim to get new episodes out every single Monday. All right, let's begin. First, let's list out the types of retirement accounts that are generally available to W-2 employees. I'm making that distinction because if you're a sole proprietor or a business owner of any kind, you have somewhat different options when it comes to the types of retirement accounts that are available to you. But in this two-part retirement account series, we're just going to focus on the regular employee options, which are traditional 401k, Roth 401k, traditional IRA, and Roth IRA. So what is a traditional 401k and what does that even mean? 401k is really just the section of the tax code that governs this particular type of retirement account. A traditional 401k is a tax-sheltered account that allows an employee to divert a pre-tax portion of their salary as a savings vehicle for retirement. The law for 2018 allows an individual to contribute up to $18,500 into a 401k. But if you are over 50, you are allowed to contribute an extra $6,000 on top of that as a catch-up. It is important to note that this is a maximum limit for 2018, as this amount is subject to change based on the discretion of the IRS for cost of living adjustments. For example, in 2017, the maximum allowable contribution was $18,000, so it increased a whopping $500 since then. By law, you are not allowed to access the money in your 401k, whether that be traditional or Roth, until the age of 59 and a half. If you do, you'll be subject to a penalty of 10%. The money that is contributed into a traditional 401k has not been taxed as income yet. So when you're ready to take withdrawals from your account, starting from age 59 and a half, that money will be taxed as ordinary income. The government assesses taxes on your traditional 401k withdrawals based on your tax bracket, just the same way that income taxes work on your paycheck. The beauty about the traditional 401k is that your contributions actually lower your taxable income for that year, meaning you could potentially use contributions into a 401k as a way to place yourself into a lower tax bracket, resulting in you paying less in taxes for the year in which you contributed and keeping more of your hard-earned money for yourself while at the same time saving for your golden years. Please do whatever you can to avoid touching that money before the age of 59 and a half. The problem with doing so is that the money will be taxed based on your tax bracket, and an additional penalty of 10% will be tacked on top of that. So if you're currently in the 24% tax bracket and decide to withdraw money from your traditional 401k but are not 59 and a half, you'll have to pay 34% in taxes to the government. So that's 24% because of your tax bracket and 10% for that early withdrawal penalty. So if you're looking to withdraw $100,000 from your traditional 401k and you're 45 years old, expect to pay $34,000 of that money just to the government alone in taxes. Look, the government is trying to deter people from touching that money, and I would strongly recommend not doing so. Another thing to remember with both traditional and Roth 401ks is that once you turn 70 and a half, you are required to start taking minimum distributions from the account, even if you are working or don't need that money yet. Those are called required minimum distributions, or RMDs. There's a whole formula to figure out what your required minimum distribution would be, and I will link to the IRS website so that you can figure that out for your particular scenario. The last thing I want to mention with traditional 401ks is that your ability to contribute the maximum amount allowed, that is that $18,500 I mentioned earlier, and the $6,000 catch-up provision if you're 50 or over, begins to phase out as you meet a certain income threshold as defined by the IRS. I'm not going to go into the weeds with that, but before you make any sweeping changes to your 401k contributions, talk to your accountant, your HR representative, but also feel free to send me a message and I will walk you through how to figure out the amount that you are allowed to contribute. With me so far, type money goals in the comments below to let me know that what I'm saying makes any sense. At this point, you've heard me mention something called a Roth 401k. A Roth 401k is similar to a traditional 401k in that you can contribute up to $18,500 and that $6,000 catch-up provision if you're 50 or older for 2018. But your contributions, unlike the traditional 401k, are actually after-tax money. Roth 401ks are somewhat new to the retirement account world, and not all companies offer them. So if yours doesn't, no worries. Traditional 401ks are a wonderful retirement vehicle and should be taken advantage of. If you do have both the traditional 401k and the Roth 401k available to you, keep in mind that you can contribute funds into both accounts, but the total contributed in both accounts can be no more than that $18,500 or $24,500 if you're 50 or older. The beauty of the Roth 401k is that because you contribute post-tax funds into the account, the money inside grows tax-free. So while you would pay income tax on withdrawals from a traditional 401k, you don't pay any income tax on withdrawals from a Roth 401k. Roth 401ks are well suited for people who think they'll be in a higher tax bracket in retirement than they are now. So those people would rather pay taxes on the money now and then withdraw it tax-free later on when they're in a higher tax bracket. Just like with a traditional 401k, you will incur a 10% penalty for withdrawing funds before the age of 59 and a half. And just like the traditional 401k, RMDs or required minimum distributions start once you turn 70 and a half. So that's an overview of traditional 401ks and Roth 401ks. I hope I was able to clear up some confusion and give you a basic foundation on what these two accounts are and how they differ from each other. Give me a thumbs up or a thumbs down to let me know. And if you found this episode useful, share it with someone who might find it helpful as well. Next week, we'll dive into the remaining two types of retirement accounts, traditional IRAs and Roth IRAs. So make sure to click the subscribe button and ring that little bell so that you'll be notified as soon as the episode is posted. I hope that these videos have been helpful so far. But while listening and learning are wonderful, meeting your financial goals will not happen unless you take action. So start implementing the lessons from these videos and buy your life back so that you can own your future. I would love to help you in any way that I can on this journey. So if you're interested in one-on-one coaching with me, send me an email to keepcalmandmoneyon@gmail.com. Thanks for watching, and don't forget to keep calm and money on.